Tonight, the gold to silver ratio didn't just drift, it jolted. And that jolt is the reason you're here. In the last stretch of trading, silver strength started pulling the ratio downward fast enough that single digits is no longer a meme. It's a live scenario. And if that scenario keeps unfolding, the market isn't preparing for a normal uptrend. It's preparing for a repricing. Here's exactly what happened. Silver pushed into a higher gear, the ratio started compressing, and the conversation shifted from, is silver moving? To, how far can it outrun gold before the crowd notices? Because once the crowd notices, the move often changes character. It gets louder, faster, and way less forgiving. Now, quick thing before we dive in. I'm running a campaign to wipe out copycat channels that recycle original work and confuse new viewers. If you value what we do here, hit subscribe and comment OG John AG so I can spot the real ones. My YouTube stats also show a ton of you watch without subscribing, and I'm not mad. I'm just asking you to help me keep building. One tap makes a bigger difference than you think. And because I want the real audience close, I also opened a WhatsApp channel where I drop daily updates, quick notes when the market flips, and the day's video link so you don't miss key moments. It's in the description. Keep it simple. Join there, and you'll be ahead of the headlines. All right, so jumping in. Why is everyone suddenly whispering about a 7-to-1 ratio like it's a countdown? Because the gold to silver ratio is not just a chart. It's a pressure gauge. When it falls, it means silver is outperforming gold. And when it falls hard, it usually means silver is not just participating, it's leading. Most people treat silver like a cheaper version of gold, a smaller brother that follows along. But silver is a different animal. Gold supply is mostly gold supply. Silver supply, on the other hand, is weird. A massive portion of global silver is not mined because someone wanted silver. It's mined because someone wanted copper, lead, zinc, and other base metals, and silver shows up as a byproduct. That one detail changes everything. Because if demand for silver spikes, the industry cannot simply flip a switch and flood the market with new primary silver supply. The majority of production is chained to the economics of other metals, so even if silver screams higher, the supply response is slow, messy, and limited. And that's when price becomes the release valve. This is why ratio collapses can be violent. The ratio isn't only measuring value, it's measuring stress in availability, stress in sentiment, and stress in positioning. When the market senses silver tightness while gold stays strong, the ratio can compress faster than most people can emotionally handle. Now, a lot of you are thinking, okay, but is it too late? And that question is usually a sign you're looking at the wrong scoreboard. Late for the first leg? Maybe. Late for the whole move? Not necessarily. Because parabolic markets don't pay you evenly. They pay you in bursts. Early on, the move feels slow, boring, annoying. Then the market flips into acceleration, and the same price action that bored you starts sprinting. That's the law of the parabola in plain language. Returns compress into shorter windows as the trend matures. And when that happens, your biggest enemy is not the market. It's your own impulse to chase at the worst time. Here's the part people don't like hearing. The closer we get to major milestones, the more dangerous leverage becomes. Not because the long-term idea is dead, but because the path gets rougher. Pullbacks get sharper, fake breakdowns get nastier, and the market can wipe out leveraged positions even while the bigger trend remains intact. So the smarter framework is this. Hold a core position you can stomach through volatility and use a tactical layer for adds on pullbacks and trims into rips. That way you're not all in emotionally, and you're not all out when the move continues. You're managing a campaign, not buying a lottery ticket. Now let's talk about the single-digit obsession because there's a reason it creates so much heat. When the ratio gets into single digits, the narrative changes. The crowd stops debating and starts watching. And when enough people watch at the same time, the market often overshoots. Overshoots are where the headlines are made. It's where silver can sprint past what feels reasonable, not because it will stay there forever, but because the market has momentum, scarcity anxiety, and positioning stress all hitting at once. And yes, ratio overshoots can happen too. People say, it can't go to 7, then it goes to 7. People say, it can't go to 5, then it taps 5. Does it live there? Usually not. But touching it can be enough to shake the entire ecosystem. Now, there's another angle that makes this setup dangerous for casual investors. The stories that get pushed the moment silver starts outperforming. You'll hear the same playbook. This is the top. This is a bubble. This is the last chance to get out. And sure, parabolas can end violently. But notice when those narratives get loud. They usually arrive right when regular people finally pay attention, because fear is the easiest way to shake weak hands. If you've watched any market long enough, you know the sequence. When an asset is quiet, nobody covers it. When it starts moving, headlines show up. When it starts making people money, warning articles flood in. And when it becomes obvious, volatility spikes. That's why I keep saying, don't trade headlines, trade structure. Structure is the difference between a real trend and a fake one. A real trend holds higher lows, recovers quickly after dips, and keeps reclaiming key levels. A fake trend pops and then bleeds for weeks. So if you want the cleanest read on what's next, focus on the behavior after the next pullback. That pullback, whenever it comes, is going to answer a lot of questions. Here's a practical way to think about it. If silver dips and instantly gets bought, that tells you demand is impatient. Impatient demand means the market is tight. Tight markets don't give many second chances. But if silver dips and the bounce is weak, that tells you demand is cautious. Cautious demand means the market might need more time before the next run. Either way, the dip is information. Treat it like a message, not a betrayal. And don't ignore the paper game moments. In stressed phases, you can see sudden sell waves that appear at inconvenient times, designed to create maximum doubt. The goal is simple. Force emotional selling, then let price recover once the panic is done. Understanding that game exists doesn't make you paranoid. It makes you prepared. So here's a retention rule I live by. Assume the next couple of weeks will be messy. Assume there will be at least one move designed to scare you. If you plan for that, you won't be surprised by it. And if you aren't surprised, you're harder to manipulate. Now the cliffhanger. What happens when the ratio cracks a level everybody is watching? Because once a level becomes obvious, it becomes a magnet. Traders pile in, stops cluster, and liquidity hunts begin. The market often does something dramatic right there, either a violent continuation or a violent shakeout. That moment is where prepared people separate from hopeful people. So if you're watching the ratio for 9, 8, and 7, don't only watch the number, watch the reaction. Does it sprint through with no hesitation? Does it tag the level and snap back? Does it churn around it while momentum stays hot? Those micro reactions are the fingerprints of what's coming next. And this is exactly why I want you on the inside. Join the WhatsApp channel in the description for daily updates and key levels. And if you haven't yet, subscribe now. One click keeps you connected when the market moves too fast for explanations again. Here's another key piece, industrial demand. Silver isn't only an investment metal. It's used, consumed, built into things. That means above ground silver isn't as available as people assume. Some of it is locked into products. Some of it is scattered. Some of it is uneconomic to recover quickly. Meanwhile, gold is mostly hoarded and stored. So if you get a moment where investor demand rises at the same time industrial demand stays steady, silver can tighten fast. And when it tightens, price doesn't politely adjust. It can gap, spike, and overshoot. Now I want to ask you two quick questions because your answers tell me what the crowd is thinking. First, do you believe the next major silver surge is driven more by investors chasing momentum or by industrial buyers who can't delay supply? Second, if the ratio hits 7-1, what happens first? A shortage narrative or a paper smash meant to scare people out? Drop your take in the comments. Also, quick mid-video plug in a creative way. If you want silver-related success stories, there's a link in the description to another channel that shares how people actually made money, what mistakes they avoided, and what strategies worked. Go subscribe there too, because studying real wins can sharpen your instincts. Back to the chart logic, but in human terms. When you see multiple consecutive strong periods of gains, markets often need a breather. Not a crash, a breather. A localized high where price either chops sideways or dips to cool momentum before the next run. That rest is not betrayal. It's structure doing what structure does. So, if silver stalls for a week, don't panic and assume the story is finished. The better question is, does it hold key support while it rests, or does it break down with force? If it holds, that rest can become the runway for the next leg. And here's the cliffhanger you should keep in your head. The biggest moves often come after the last easy pullback. The market gives a dip that feels like relief, like danger past, and strong hands reload. Then the next push is the one that brings the public. That's why chasing every green candle is a trap. The cleaner entries often show up when the screen is red and your emotions are loud. If you don't plan ahead, you'll miss them. And if you plan poorly, you'll overreact. Now, let's bring in the supply bottleneck again, because this is the engine under the hood. If most silver comes as a byproduct, silver supply is tied to base metal cycles. If base metal mining slows, silver supply can tighten even without anyone deciding to cut silver output. That's a weird dynamic, and it's exactly why silver can surprise people. So picture this. A weakening economy reduces base metal production, while monetary anxiety boosts investment demand for silver. Supply is slow, demand is fast. That mismatch is where explosions happen. And this is where four-digit conversations appear. Not because anyone can guarantee them, not because you should build your life around a number, but because overshoots can be extreme when a market reprices under stress. The first unreal level becomes a stepping stone, and the next levels get discussed because the crowd is trying to map a move it doesn't emotionally understand. But we need to be responsible here. If the market is in a melt-up phase, the correct posture changes. Early phase is accumulation. Melt-up phase is risk management. That means trimming leverage, tightening plans, and protecting the gains you already earned. The goal is to stay in the game, not to brag that you never took profit. Now, a lot of people ask, why doesn't everyone just pile in if it's so obvious? Because the journey is brutal. Silver does not move in a straight line. It moves like a coiled spring. It pops, then snaps back, then pops harder. Most people can't tolerate that. They buy the pop and sell the snapback. Then they watch the next pop without them. So the discipline is simple, but not easy. Decide what you're willing to hold through noise. Decide what you'll trade, and do not mix the two in a panic. If you keep changing your identity mid-move, the market will charge you tuition. Now, let's talk about the ratio itself in practical terms. A ratio collapse can happen in two ways: gold falling while silver holds, or silver rising while gold holds. The second one is the more explosive for silver holders because it means both metals are strong, but silver is stronger. That's when silver can feel like it's teleporting. If that's the environment we're entering, it explains why the conversation shifts from normal targets to historical extremes, because the market is not trying to be polite. It's trying to find equilibrium under a new set of pressures. And if we do get a consolidation, watch how it behaves. Does the market dump and stay weak, or does it dip and get bought instantly? Fast buying on dips is a signal of hungry demand. Slow, lazy buying is a signal of exhaustion. The tape tells you which one you're dealing with. Now I want to speak directly to the person who's feeling overwhelmed. You don't need perfect timing. You need a plan that survives volatility. You need position sizing that lets you sleep. You need rules that stop you from doing something stupid on a random red day. Because the biggest risk isn't that silver never goes higher. The biggest risk is that silver goes higher in a way that knocks you out before the main move. That happens when you chase, over-leverage, and then panic on the first sharp pullback. So the best move is to stay rational. Build exposure in layers. Keep dry powder if you're adding. Protect your base if you're up. And don't let a single candle convince you the story ended. And I want to hear from successful people watching this. If you've made money in markets, business, or any hustle, share one short lesson in the comments. It can be one sentence. What was the biggest mistake you stopped making? Your experience could lift someone else's confidence. Now to wrap the logic into one clean chain. Silver supply is inelastic because it's mostly byproduct. Demand can surge from both investors and industry. Parabolic trends compress returns into shorter bursts. Major milestones can trigger rests, not endings. And the gold to silver ratio is the scoreboard that tells you whether silver is leading. So here's what I'm watching next. Whether the ratio continues compressing towards single digits, whether silver holds key support during any rest, and whether dips get bought aggressively. If those boxes stay checked, the next leg can surprise people who think the move is already done. And if you want me to keep tracking this with you, do the simple thing. Subscribe, comment, OG John AG, and join the WhatsApp channel in the description for daily updates. Also, if you want to boost the community, share your success stories below. I read them, and so does everyone else who needs that extra push. Because if the ratio is truly collapsing back towards 7-1, the next chapter won't whisper. It'll hit fast, and it'll reward the prepared, not the emotional. So tell me in the comments, are you positioned? Are you waiting for a pullback? Or are you still on the sidelines watching?